You know, everybody talks about having a crystal ball and looking into the future to see what it looks like. No one really knows. Day to day, week to week, election to election, we couldn't tell you what's going to happen by December of this year. Can't tell you what's going to happen by really the end of the month of June this year. Why? We don't control it. We don't have any way of knowing what the political powers to be are going to decide in terms of policy and war and intervention. We have no idea what the current energy crisis is going to do to all kinds of different asset classes, supply chains, disruption, fuel, economies, income, unemployment. We don't know. So, the best anyone can do is use the preponderance of their own information, the amount of data coming into their world, and say, from what I know, what I've learned, the history of my being here today, combined with my awareness and acuteness on the overall data that's out there, that conclusive crystal ball is a point in time today. So I'm going to talk about the Middle East and I'm going to talk about oil. And this is my own personal opinion and it's based on what I know today. Here's what I see happening. I see that the end user, the buyers of Middle Eastern OPEC oil, including Russia, are making some dramatic changes that will probably be everlasting for at least 10 to 20 years. They can no longer afford to rely upon the Middle East for consistent oil supply to a large degree. I know some of the other OPEC countries, Middle Eastern countries, are quickly building pipelines to divert and go around the threat of Iran ever using the Strait of Hormuz to stranglehold global supply. They want to go to different basins, they want to go to different oceans, and I understand that. In the meantime, the buyers on the other end, Japan, Europe, other countries that rely on Middle Eastern oil, they're saying to themselves, well, I'm glad you're doing that, and I will be glad to buy oil to some degree, as I have been the last 40 or 50 years, but I'm going to have a second choice. I'm going to have a different area of the world to buy oil in case there's ever a disruption again. Wait a minute, we're building different pipelines, we're going different directions. That's true. Pipelines can be blown up, pipelines can be disrupted, the Strait can be shut down. I believe you're going to take care of business. I believe you're going to have alternative routes that make me feel comfortable, but I also believe it seems like there's always chaos, there's always disruption, there's always geopolitical risk. So I, as the consumer, are going to choose to have some of my oil bought from the Middle East, but I'm going to find a secondary source. I'm going to go down to the Vaca Muerta field in Argentina. I'm going to go to Brazil, who's making large discoveries offshore and is growing every day in terms of supply. I'm going to look at Venezuela as oil that's going to continue to grow, that if they can maintain some kind of a neutral government that has really a desire to grow their economy and increase their production, I'm going to go look up, lining myself up to buy oil out of Venezuela. I'm going to look at myself buying oil out of Guyana, which is record-setting pace of new production coming in line between Exxon and Chevron down in that basin. I'm going to look at where else I can get some part or a good portion of my oil today because of the Straits of Hormuz being shut down. But long term, I'm going to always maintain a second or tertiary source of my energy. Now, let's talk about what that's going to do to the Middle East. If OPEC in the Middle East were producing a certain amount of oil every day, and maybe 10, 15, 20% of their customer supply demand, their demand from that supply, says we're going to get it from somewhere else. Well, now we have OPEC and we have the big producers in the Middle East saying, wait a minute, we've lost market share. So let's look at it the next 12, 24, 36 months. If there is a secondary market where there's barrels of oil and supply of energy can be had or bought or committed to from these other areas I described, they're going to sign up for it. They're not going to renew those contracts. They're not going to tell the suppliers out of the Middle East and OPEC, we need another 5 million barrels of oil. We only need 1, 2, 3 million barrels of oil because I'm getting the other 2, 3 million barrels from somewhere else. That's going to significantly financially shift the Middle Eastern's financial structure and what goes on in those financial decisions with those countries in the Middle East that have oil production. And the only thing I've seen in 40 years, whenever there is a disruption or a threat to market share, what OPEC, Saudi, all the producers in the Middle East do is they say, what we do know is we have some of the cheapest production recovery costs of any oil basin or supplier in the world. We can get it cheaper than anybody else because it's so abundant. So let's say for the next 12, 24, 36 months, we see this secondary, tertiary market supplying oil. Straits of Hormuz gets resolved. The Iranian war goes to neutral, whatever that looks like in terms of peace. And all of a sudden now everything goes back to normal in 12, 24, 36 months. And everybody says, wait a minute. Before the war started, here's what we had. The war's over. The straits open up. Now here's what we have. We've got an extra 5, 10, 15 million barrels of oil no longer is needed out of the Middle East. It's being taken from other supply sources. How is Saudi, OPEC, how are they going to regain that market share? They're going to do what they always do. They're going to flood the market. They're going to calculate and determine that every other source of crude oil from Guyana, from Argentina, from Brazil, from the U.S. shale plays, they're going to determine that they all have a break-even substantially higher than what we have in the Middle East. So we don't want to, but we need those competitors to go away. We're going to crush them through economics. We're going to produce and sell oil at such a cheap price, it's going to cause them to economically fail. How do I know that? Because all the new sources coming online, everybody's saying, let's get all these other sources fast-tracked as quick as we can because oil looks like it's at $90 to $120 a barrel. We know it's probably going to stay north of $75 to $85 a barrel even when everything gets cleared up because that's just the cost going forward relative to the supply disruption incurred. If that's true, that means that any price reduction below 85 or 75 means these other sources are producing at break-even or a loss. It won't last very long. That's why the North Sea, that's why you have certain areas like Vaca Muerta in Argentina. That's why you see Brazil. They all have been contained or restrained on oversupply because their break-even so high. So if I'm sitting on the consulting board for the Middle Eastern producers and I said, you're going to lose a lot of market share for the next 24 to 48 months, you must be prepared to regain that by overproducing supply, flooding the market, crushing them economically, and derailing any future capital deployment. So between the 36th month and the 60th month, we're going to do everything we can to flood the market with supply and drive oil prices down below $65 a barrel, even as low as $50 a barrel, to make the pain so great and for such a period of time, 6, 9, 10 months, that everybody else who came on the scene to save the world from global crude oil supply shortages now realizes they can't play the game at those lower prices. Capital drives the market, and capital has to have certainty of a return and safety of principal and safety of reward versus risk that makes economic sense or it does something else. In my view, we've got 12 to 36 months of disruption of Middle Eastern supply, followed by an oversupply in 3 to 5 years that pushes oil prices down to a point where these other producers feel the financial squeeze, the derailment of capital investment going forward. And what does it look like in 10 years? In 10 years, we're still going to be $85 to $90 a barrel. But it's going to be based on terms of certain supply sources like the Middle Eastern countries and OPEC, who said now that we've run off the other competition and it took 5 to 8 years to get there, we're back in control. Global demand is not 101 million barrels a day. Now it's 105 to 107 million barrels a day. We run our competition off, or we minimize their ability to grow supply. We now are back to our original supply and demand economics that we had before the Iranian war started, and it's going to take 5 to 10 years to get that whole process through. What's the backside of 10 years? Much higher oil prices. Not 66, not 75, 85 to $100 a barrel. What happens to the alternative energy that's coming online today? They'll still produce, but they're going to be constrained and they're going to be capped. How do I know that? Because that's exactly what happens to U.S. producers. We see certain shale basins and we see certain operators that either go forward aggressively or they shrink back. And it all has to do with economics and the source of capital and the supply and demand curve. So if you take that to an exponential global market, it's the same economics, just different players, different parameters. We have a dynamic energy marketing take place. High reward the next 12 to 36 months, a drawback in 48 to 68 months, 72 months, something like that, and then a stronger forward motion the last half of the next 10 years, the last third of the next 10 years, which says the base price will be much higher, less competition, but definitely more control of market share by those producers that have really, really low recovery costs. That's what my personal opinion says to expect for the next decade.